Interest rate hikes don't just slow the economy. They squeeze the entire financial system at once. Why do interest rate hikes crash markets? People hear interest rates going up and think it only affects loans or MS. In reality, interest rates are the price of money itself. When that price rises suddenly, every asset in the system must reprice. That repricing is what crashes markets. 10 reasons interest rate hikes crash markets. 1. Higher rates make money more expensive. Interest rates are the cost of borrowing. When rates rise, loans become expensive for businesses, consumers, and governments. Spending slows, investment falls, and future growth expectations drop. Markets react immediately to this slowdown, even before it appears in data. 2. Future profits are worth less today. Stock prices are based on discounted future cash flows. Higher interest rates increase the discount rate, which mathematically reduces the present value of future earnings. Even if a company's business does not change, its valuation falls when rates rise. 3. Debt becomes a burden overnight. Many companies operate with leverage. Rising rates increase interest expenses instantly, cutting profits and increasing bankruptcy risk. Investors sell first and analyze later, pushing markets down fast. 4. Safe assets become attractive again. When rates were low, investors were forced into stocks for returns. As rates rise, bonds and savings become attractive alternatives. Money flows out of risky assets and into safer ones, dragging stock prices down. 5. Liquidity dries up. Higher rates slow lending by banks and reduce credit creation. Less money flows through the system. Markets fall not only from fear, but from a real shortage of liquidity. 6. Asset bubbles start deflating. Low rates inflate asset prices by making borrowing cheap. When rates rise, the justification for high valuations disappears. Real estate, tech stocks, crypto, and speculative assets deflate quickly. 7. Strong currency hurts global earnings. Rate hikes often strengthen the currency. A stronger currency hurts exporters and reduces overseas earnings when converted back. Multinational companies suffer, pulling indices lower. 8. Emerging markets come under pressure. Higher rates in major economies pull capital out of emerging markets. Their currencies weaken, debt servicing costs rise, and investors flee risk globally. This amplifies market crashes beyond borders. 9. Fear spreads faster than fundamentals. Markets are emotional systems. Rate hikes signal tightening and potential recession. Once fear enters, selling accelerates regardless of individual company strength. 10. Policy lag creates panic. Interest rate hikes work with delay. Markets know the pain is coming but can't yet measure it. That uncertainty causes preemptive selling, often overshooting on the downside. Final truth. Interest rate hikes don't crash markets because rates are high. They crash